Hello, everyone. This is Jelena Ogilvie from Principal Wealth Partners. This is our economic update for July of 2020. Our goal today is four things: an update on COVID, where we are from both fiscal and monetary policy, our road to recovery from an economic standpoint, and a reminder as to our emotions and how they affect our investment decisions. We originally began this pandemic with a forecast from scientists of 15 days to slow the spread. At the time, that seemed so long, and yet this, of course, has not been the case. Governments globally began the difficult trade-off between public and economic health. Despite over 80% of the COVID cases as mild or asymptomatic, we shut down 95% of our economy. As new cases slowed, indicated here in blue, people began to revolt on these constraints and demand to reopen. Now, since these reopenings, we have seen a pickup, or what some call a surge in cases, to a 7-day average of roughly 60,000. This created another political response, as of the beginning of July, many states either reversed or paused their reopenings. This uptick appears to be a combination of both an increase in socialization and in testing, which increased from 100,000 to about 570,000 per day. Meanwhile, the 7-day moving average of deaths, indicated in orange, dropped by over 70% from its peak on April 21st, has also unfortunately ticked back up in recent weeks. Data today indicates the average age affected by this pandemic is 76 years old, 80% are over 65, and over 40% of the cases are coming from nursing homes. Most agree there is no life as normal until a vaccine is distributed, and this appears to be what will drive our recovery and what the path of that recovery will look like. We've seen unprecedented response from both fiscal and monetary policy. The CARES Act signed by President Trump on March 27th is $2.3 trillion in stimulus, primarily to individuals, small and large businesses, and municipalities, as seen here. And then came the Paycheck Protection Program Flexibility Act on June 5th, which addressed all the concerns of small businesses to the original Paycheck Protection Program, otherwise known as PPP, including increasing the time to use the funds from 8 to 24 weeks and pushing back the deadline and requirement to rehire workers. As of the beginning of July, much of the PPP remains unclaimed. This is due to the 170,000 loans totaling $38 billion that have been canceled after the Treasury Department said public companies shouldn't tap the PPP. All of the stimulus today represents roughly 13% of our overall economy. They have suggested another stimulus bill this summer. Indications have amounted to over $1 trillion. Possible suggestions of a payroll tax cut, reduction of capital gains tax, and a back to work bonus. On a monetary level, the Federal Reserve has launched or reopened 8 lending facilities to provide more than $2 trillion of loans to distressed corporations, municipalities, and money market funds, just to name a few. The Fed has been very vocal of their forward guidance, saying it does not expect to raise rates for a period of time. In fact, not a single one of the 17 officials offering their forecast to what the industry knows as the dot plot thinks there will be a rate hike this year or next. Interestingly enough, after the 2008-2009 crisis, the Fed didn't raise rates for another 6 years. The Federal Reserve has also expanded their balance sheet, shown here. In just a 2-month period, they have ballooned from 4.2 to 6.4 trillion, which is more than the entire 4 years following the financial crisis. The current pace is 125 billion a month of treasuries and agency mortgage-backed securities. The expectation, which is to the right of the dotted line, is that this will continue as they want to ensure there's plenty of credit available. This, of course, raises the longer-term issue of our nation's debt. Relative to our economy, this will cross 100% and surpass World War II numbers over the next couple of years. We have clearly borrowed from the future, and we'll have to address this at some point. Current discussions around the economy appear to be all about the alphabet letters, meaning that the letter indicates what our path to recovery looks like. The most likely letters appear to be these three: V, U, and W. The original forecast was led by a V shape, indicating a quick recovery off a steep decline in the second quarter. As many states are now forced to pause or reverse their discussion of a U shape, meaning a slower bounce back off the bottom. A W shape would indicate a second recession quickly following this one. We began this pandemic with a forecast for the second quarter at an unimaginable range of down 5 to down 50 by analysts. The first estimate for GDP was just released at down 32.9. The third quarter is estimated to be positive double digits and then to slow down to a single-digit growth in the fourth quarter of this year. If this is the case, that means we are out of this recession before the economists can even officially declare that we entered one. The path or the letter of this recovery will most likely be driven by health response and, more importantly, the distribution of the vaccine. In the meantime, there are signs of a path to normalization. Monthly retail sales jumped over 17%, their highest ever, from almost down 15 the month prior. TSA through the end of June was up 12% of passengers going through checkpoints at airports. And the media began to focus on other stories. The unfortunate civil unrest following the death of George Floyd in June, deterioration with trade relations with China, and of course, the start of a new election campaign. This recession has been most notable in our unemployment, which began the year at a 50-year low and then peaking in April at 14.7. Since then, we've had 2 months of job gains. In May, it was in fact, quote, millions better than expected, unquote. Unemployment has fallen to 11.1%, most in leisure and hospitality areas. It will most likely remain in the double digits for this year, and the expectation is to fall to around 8% by the end of next year. This pandemic may result in one of the quickest equity rallies in history. But yet again, we are reminded as to how emotional we can be, and to our detriment at most times. Investors fled to safe haven assets, one being the US Treasury, which pushed yields below 1% for their first time in history. The second safe haven was cash. According to Fidelity, almost 20% of individual investors sold equity holdings, as shown here. And that percentage was much higher for the older demographic in their 60s and above. In fact, the personal savings rate soared from 8% in February to 33% in April. And all of this occurred while money market rates plunged. As an example, the Schwab Value Advantage Prime Money Market began the year with a yield of 1.5, and as of the beginning of July was 0.11. This does not appear to be thoughtful decisions of individuals based on their financial needs. In conclusion, it appears that the worst is behind us from both the pandemic and economic standpoint. We may, in fact, already be out of this recession. The future of our health response and a vaccine will indicate the alphabet letter that our recovery will look like. As we move into the second half of the year, our attention will turn more to the election, tensions with China, with, of course, continued emotions from investors. Stay tuned for our upcoming discussions around the election and a market update as well. At Principal Wealth Partners, we are here for you, and thanks for listening.